Okay. Welcome everyone to ValeTalk. This is Manesh. Unfortunately, Ryan, our fearless leader today, is not available, so I'm going to be substituting for him as the main person, the host. And today we also have Antonio and Costa on the line. Hi guys.
Hello.
Hello.
Good morning.
Good
Good afternoon
morning.
here.
Today's topic is going to be moving averages. What do you need to know about them? I think everyone's seen moving averages. It's probably the most popular indicator in the world. There's so many different ways a lot of people use it. So today we're going to go to our panel and let's talk to everyone on how they use moving averages and what you find most valuable about it and also the weaknesses about it. So, Antonio, since Brian always says we'll go with the oldest experienced person first, let's go with you first. What do you think of
Great,
moving averages and share your opinion on it?
great, Manesh. Thank you. Well, moving averages, I think this is the most important indicator in technical analysis. I think that everybody uses moving averages in certain aspect, included those that said I don't use moving averages. They will use the concept of the moving averages, which is the mean reversion. The mean reversion theory is the idea that when price moves significantly away from its recent average, it may eventually move back toward that average, right? So, if someone, for example, use a trades with SMC, but he don't use technical analysis on his chart, he will trade on this move back to this liquidity zone, which basically should be a moving average, right? So moving average is a very powerful indicator that we use basically to see trends and to see corrections during a trend. That so moving average, I think it's the basic indicator that everybody should use when he begins with technical analysis, when he begins to understand the trends and the corrections. Then we present the moving averages.
What versions of moving average do you use? Most people, they know about the 50-day moving average, the 200 for longer periods. Institutions use those too a lot, but some also use a 10 and 30. So, I'm sure that's going to be different for Costa too. So, what versions do you use and why do you use those type of moving averages?
Great. Well, I start with the powerful 200 moving average, the 200 simple moving average, which is the most powerful of all, where the institutions use it every day. The quant traders use it as well. So it's a must-have line on your chart, especially on your daily chart, right? When we see
Okay.
the gold, for example, the Shao, you see the on the daily chart, the 200 moving average is a very powerful one. Basically, we can use it as indicator of support and resistance, dynamic support and resistance. That's the first usage that I use with the 200, and then we can see that as a trend indicator. Most of the people, when they're beginning to see the charts, they lose himself. Where is the uptrend, where is the downtrend, what's the active trade at the moment. And it's pretty simple. You see the position of the price regarding to the 200 moving average. If the price is above the 200 moving, it's an uptrend. Below the 200 moving average is an uptrend. So it's a very simple. It's a very simple conversation. And then I use the 200, the 20, the 20 exponential moving average. This is most as an indicator of a correction. For example, during an uptrend, the
Mhm.
prices will move away from this moving average, and when he comes back to a pullback on a 220 moving average, the exponential moving average, and makes a hammer, for example, or an inverted hammer during an uptrend, then I use this as a signal to buy, right? So this is pretty much what I did. There's
Okay.
there's a special effect when the prices are between these two moving averages. When the prices are in between the 20 and the 200, it's a warning signal because we didn't see what is happening. Because when we see the prices, for example, above the two moving averages, okay, this is an uptrend. When the prices are below these two moving averages, this is a clear uptrend. But when the prices are in between, this is a yellow zone, when the traders should be careful, because probably there's a reversion going on the trend. So this is basically what I do with the moving averages. But this is an important thing that we should care of, is that the moving averages are a trend indicator. So when the prices are not trending, when we have a sideways market, for example, the moving averages will be flat. So this is a clear indication when there's not a trend in the market. So when the prices are below or above the moving average, especially the 20, we have a trend. When the prices are, when the moving averages are in the middle of the prices and it's flat, there is no clear trend in the market. It's basically what I did with the moving averages.
It's interesting because you use different types of moving averages. Most people either use all completely simple moving averages. Some people use the EMA completely. You got a mixture between the two, which is different. So that's
Yeah,
pretty unique.
I did this, Manesh, because we know that one of the sideways of the moving averages, or one of the problem is that moving averages are a lagging indicator, right?
Right.
So when we use the exponential, we try to
Hmm.
avoid a little bit or correct a little bit this lagging indication, especially on the shorter periods. That's why I use the exponential to try to be more accurate to the price, instead of the simple ones, because the basic concept of the moving averages is that the moving average is the fair price of their exiting. For example, in a 20-day period, when we say the price of the moving averages in a 20-day, it's the fair price. It's the fair price, right, of the instrument on that period. So I try to correct this lagging in the moving averages, in the simple moving averages, with exponential moving average in the shorter term in the shorter periods.
And I just displayed that right here. You could see it, the difference between the red and the gray. You use the
Yeah.
red one, which is the correction one, and that's based on EMA. And basically, the gray one here is the SMA, and you could see the price difference there. You could definitely see that the gray is a little more flat going forward. So you could definitely see the big difference there for the correction, especially here when they start flipping over the 200. Is that correct?
Yes, that's it. We can say that the exponential it's closer to the price than the simple, which is more wider. So I preferred the closest one, which has the give us the sensation, that give us a better sensation of what's going on with the price.
How about for the 200? Why not change that to EMA too to get closer, even though it's long term?
That's a good question. And the simple question is that everybody Every big player in the market uses the simple one. I would
Yeah.
prefer to use the exponential, right?
Okay.
But if the big guys are using the simple, the central banks are using the simple to put this position. Let me see the fair price for the big guys.
Yep. No, I definitely agree. Okay. Thank you. That's interesting information. Okay, Costa. What do
Mm.
you think? How do you use moving averages? Do you use the same ones? Different?
Right. So, personally, I use the ribbon EMA. So
Ribbon
the
EMA.
yeah,
Okay, so
ribbon EMA. So yeah, basically like a group or a combination of moving averages, and I do 20 and then 50 and 150. Right. So yeah,
I don't
I
even
think
see them
for
here.
ribbon, RIBBON, email reborn, I think.
So
EMA.
EMA. Ah, here it is. Okay, so you use this one. I never
Yes.
even heard of this one.
So yeah, basically like
Have you,
it's
Antonio?
Yes, I know
yes.
the concept, and I use the concept, but especially the ribbon moving average. No, I didn't use it, but I know the concept, and I know and I use the concept now, which is the 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 distanciation, between the price and the moving average. Yes, this is important.
Okay, so
Right.
Antonio, explain to me and everyone what is the difference between the SMA, the ribbon, and the exponential. Well, so the ribbon is just like so it seems like it uses a couple of MAs, moving averages. Is that correct?
Using the EMA. So you
Is
use
this
the SMA you can change to EMA, the ones that
okay? So change all this to
the line,
EMA.
yeah. Uh-huh. And
Okay,
then
so this just puts a whole bunch of moving averages together. That's what the ribbon does.
yes, that's what Urban does. So it's like a combination of
Ah,
the
okay.
averages. So yeah, that's why it's called ribbon because I think when you plot them together, they create a band or
Huh?
ribbon like area on the chart itself. So yeah, in my
Got
case, I
it.
use 20, 50, 150 EMA as a ribbon.
So hold
So
on.
yeah,
So 20, 20,
50
50,
and 150.
and 150,
Right.
and 200?
No, no, I don't. It's just like
No.
a personal preference. No, no,
Ah, okay. So you don't even use 200.
no.
So
So yeah,
why?
I think 150 is already enough because I believe when it's ribbon, it's kind of moving and it's more of a long-term trend filter. And I do use like a maybe time frame 15 minutes to 1 hour. So I think it
Okay.
already enough to do 150. And I'm using this because even when the trend's still going up, we can also yeah, for me we can also set like a if we have if we can have like a position in it. So for example, there's a correction there from 20 to 50, right? And then we could
Yep.
put like a entry right there in which
Right here.
the no, the correction. So after that, after it breaks, right? After it breaks,
Uh-huh.
then
Yep.
there's
Oh,
a
here, this
correction.
correction here.
Yeah, there's a correction there. Right.
Okay.
So again, I use the 150 EMA actually for the stop loss if we going to for the long position with a 1-to-1 ratio. So that's what I do. So I've been
Okay.
yeah because I tried already back tested it. It's actually one of the very first of many of my strategies when I decided to learn about this trading. So that's why I use that, and sometimes I just still use it for now because yeah, it gives you a lot of I think security. You don't have to look always into the chart. You can do other things, and you already put the set for the TP and SL for race ratio 1-to-1 thing. That's
Okay.
why I use that.
Interesting. So So you do use the this common between both you guys is the corrective one, as Antonio mentioned, the 20 MA. That's the one that's common between both of you guys, but then it starts varying a little here between the 50, 150, and the 200. So that's interesting to see. Do you guys use moving averages too with the SMAs and the EMAs?
Yes.
Because a lot of people use a combination of between moving average and also like the MACDs and stuff like that.
Well, I think I just use the EMA ribbon because actually it's already like
Okay.
a combination, I believe, yeah, of several moving
Okay.
average. So I think it's enough for like indicator.
Okay.
So
That's interesting. Okay. So, Antonio, what do you think of the different versions?
No, it's very nice. It's very interesting. He's very interesting. I was hearing Albert explaining, and it is pretty nice trading system, right? Because it's not just analytical tool, but it's a trading system as well. Because he used the 150 as a stop loss
yeah.
region. So
Yep.
it's not just an analytical one, but this is a trading system, and it's very good to see this. We can see that basically the concept of the correction to the 20 M&A is still present, right? It's the
Yep.
it's the common concept in the market. I like the idea of entering the trade on the first breakout, as he pointed on the bottom, and
Yep.
this is very nice. And to keep using the 115 moving averages as a stop loss, because it is a dynamic region, right? So it's not just like a static price for the stop loss, but it's dynamic, which is very nice. And
Would
Costa,
you find? Mhm. Sorry, go
Yeah.
ahead.
no, and a small question to Costa, because this is seem to be a nice trading system. Where, what do you use to exit the trade, the take profit of this operation, for example?
I do for example for the first one, if there's a breakout on the trend itself, then I use the latest swing low, right? So the price will be
Right here. Would
yeah.
this be it?
No, when the first
Started.
break, right? When the first break,
Okay.
so the 20 is
Okay.
breaking for all the others EMA, and then I use uh the first candle that already breaks that, and then I use the stop loss on the last low, on the last swing low, and then I do 1-to-1 risk reward ratio. That's I think what I do.
So do you? Okay, so you use that. So you don't use any of the EMAs for your stop. There's a
For
trailing stop or anything.
for the first breakout systems, I do the latest swing low, but not for the EMA.
Okay.
So EMA is just for the entry confirmations. If we have like a trend going.
Do you want to show your chart, or do you want to
Uh,
mark off in here?
actually, it's actually
Or
pretty much the same. But okay. Uh, let me do my chart. All right.
okay, let me stop share.
Mm-hmm.
Hey guys, if you, I've never hosted before, so Ryan typically does. So if you want to share your screen, just let me know.
All right. And we do have here. So the white one is the 20 EMA, and then we have like a momentum candle here. I do also like momentum candle strategy too, but this is when it breaks, and the first candle after it breaks, then I do here, and then I do like a long position, for example here with 1-to-1 ratio. I do the last low here for the last all, and then this is for entry. Then we go here. Right. So it's already fulfilled. But yeah, that's the for the best case scenario, of course, right? So whenever this is like sideways, this is the weakness of it, right? This is the weakness of it. Like this going sideways in the 15 minutes. Usually I do like a trade here, and this is a kind of the downside of the EM itself. So there you go. All right. So actually breaks, and this is where I put my stop losses, the EMA 150, right? So 1 to 1 risk reward ratio. So the less it's correct, the less the correction is, I think the broader the range itself, right? So this is 1 to 1 and going this. Right? So as long as the trend is not changing, I think yeah, we can always put like some kind of a open here. So we can open here, we can open here because it's still uptrend, right? It's easy. Yeah, it's just like again for me personally, moving average is like basic, interesting, and it's very hard. Sorry, it's very easy to tell to people to help them understand, especially for the beginners that want to learn about trading, wants to learn about the candle chart. I think so. I usually use this. That's it.
Okay.
Okay.
Antonio, what do you think? You want to share your chart? You want to me to kind of present mine, and you kind of want to talk about how do you
Yes.
manage a trade, your style for it. So we'll go through that because I'm kind of the one that goes opposite. So I don't believe in moving averages. So I'm kind of the con guy here.
Okay. Well, this is my chart on the gold. We can see the 200 moving averages it's the blue one. Uh, we can
Okay.
see how it works as support and resistance. In this region we had a support, in this region we had a resistance, but it breaks and the gold is clearing going towards the next resistance, the 47.65, which is it's a green one, so it's there's a clear path on the gold going to there. Seeing the daily chart, it's not a time to buy yet, because you see the distance between the price and the 20 moving averages, which is the red one. We can see here that for example, when the prices broke up the downtrend, let me see if I can do. Yes, when the prices broke up the downtrend and began the uptrend, he like moving away from the 20 moving averages, and he comes back, to do a pullback, which should be an entry point. This hammer on the 20 moving averages. Basically, I buy on the top of this hammer with the stop loss on the minimum of this candle, and the trading is going up. Next entry should be a return on the moving averages. Probably on the next day we will see like another hammer here on these 20 moving averages, and then the price will goes to the 47.65. It's the next resistance we see on the gold. So this is the daily chart. We can use I use the same idea on the 1 hour chart or the 4 hour chart. It works pretty well. So it's a pretty nice idea. One interesting thing that we have with the 200 moving averages is that it has the magnetic effect. Okay.
Okay.
When the prices, for example, here we see clearly that there was a resistance here. Now, when the prices reach this level, the 43.80, and finds a resistance, it was pretty close the 200 moving averages. In the situation, the 200 moving averages will will pull the price. Well, it will have a magnetic effect, and we see that there's a strong that happened, a strong uptrend that reach exactly the 200 moving average. So this operation, I always teach, to the people, it's the magnetic effect. When I see in the past, for example, here we see that the same thing happened. When the prices will find a support or resistance close to the 200, will not reach it directly, but will find the resistance or support close to the 200, and then we'll have a test, and then the magnetic effect will happen, and the price will move towards the 200 moving averages. This effect happens in several time frames, not just on the daily charts, but you can see, for example, in the 4-hour charts. I don't know how to clean up the annotations here. Let me see. Yes, no, I don't know how to clean up the annotation.
It's okay.
No, I don't know. Yes, here it is. Okay. For example, in the on the 4-hour chart, we can see this effect as well. For example, in the past, here happens the same thing. Let me show here. Here, this effect, it was the same thing. The prices, are uptrend, faced a resistance in this region, and then it moves towards the 200, and then the resistance effects was in play. The 200 was always a resistance. See how long it takes to break this 200 moving averages on the 4-hour chart, but when it finally did, it becomes the new uptrend. So there's a pretty nice concept and education we can use with the moving averages, especially the 200. I think the 200 moving average in itself, it's a theme of a 1-hour class if we can explore all the applications that we can have the 200, because they're very powerful, and it is used by the big players. So when the big players see the 200 moving averages, okay, it's time to buy, it's time to sell, it's time to close the positions, it's time to open new positions. So you have to be sure that something will happen on the 200 moving average for sure.
Yeah. Now, institutions definitely use the 200 because they're more long-term than short-term than we are, right? That's the thing most people don't realize, is that institutions are more long-term, and that's why they're using the 200 to enter. However, to exit, to manage the trade, they're not using the 200. So once it crosses above it, like here, they'll look to enter, but they're not looking to exit once it touches it again. They're typically using another shorter term moving average of some type to manage the trade and to exit out X positions at a time. So that's the difference between a lot of the institutional trading and retail trading out there. So me, I am probably dead against moving averages. So I'm going to go against both you guys. And let me kind of explain why. The years, as Antonio mentioned, if you're a beginning trader, you pretty much go towards moving averages. It's the best thing out there. There's many tutorials out there and stuff like that. Of course, I started off with 50 and the 200, which is pretty much the most popular ones out there. And basically what happened was I looked for when price crossed over the 200, looking to get in long term, and then I managed it off a short term, which is a 50-day. But a lot of times what would happen is with volatility, price would sit there, swing back and forth, right? You would get close to 50, but then at that point, it was very hard to get a good reward risk ratio. So then I moved to shorter term, which is a 10 and 30, more day trading type of moving averages. So I started using the combination of 10, 30, 50, and 200, kind of like the ribbon approach, but with 4 different ones. Experimented with various different things. So for years, I traded that, especially all the way to 2000. And then during the internet bubble crash, the delayed effect with moving averages really killed me, completely killed me. So, and that's the thing a lot of people don't realize is that moving average indicators are a delayed indicator because it's based on closing price. You have to wait for the bar to close in order for that indicator to move, to adjust, and stuff like that. And that, for me, that really killed me a lot. And then, and the reason why is before 2000, I was always about win-loss ratio, right? Winning versus losing and stuff like that. And the goal always was to get to a 1-to-1 reward risk ratio. After I lost the internet in the internet bubble bust, I had to redo everything I did. So I completely changed and went opposite of win-loss ratio to reward risk. So the goal was how to get a 3-to-1 reward risk ratio. And looking at moving averages, combinations of various different things, I could never achieve consistently a 3-to-1 reward risk ratio with moving averages, even if you use short-term, long-term, and so forth. And the reason why it's based on closing price. So at that point, I pretty much went away completely from moving averages. In fact, I went away from any indicator that was based on closing price. And I gravitated more towards highs and lows for indicators and stuff like that. And that's kind of where I moved off moving averages and started pursuing more towards Fibonacci. I went into Fibonacci because you could use the pivot highs, pivot lows, and stuff like that. So I went in that path, then Elliott Wave, and then Ichimoku is pretty much where I landed up, right? So Ichimoku is not moving averages, but it represents support resistance similar to moving averages. As Antonio mentioned, it's a support resistance indicator, but it's based on highs and lows. So when you do break a pivot high, the indicator moves compared to moving averages. And that's pretty much where I went to. So if you look at here, this is the first time that it broke the 200 moving average here. If you look at this on Ichimoku perspective, this is where we're looking at. And you just keep it simple. You have a cloud here. Once it breaks above the cloud, you're pretty much looking to enter. So for us, for gold, we entered here on a 4-hour here when it got above the cloud here. Okay. And here the red line represents it's a 10 period. It's very similar to the 10 period moving average, this red line compared to the EMA here. But the thing you're going to get is it moves more. There's flatness moving and stuff like that. So when it's flat, it tells you you're not breaking the highs for the last 10 periods and stuff like that. So I moved more towards Ichimoku here. So goal is always here when it comes out of the cloud. Now it's the beginning of a new trend. You have a potential for 3-to-1 reward risk ratio. Once you start moving here, instead of it trying to get below like this green line, which represents 26 periods, we go to different time frames. So we're always looking for it to break out of the cloud. So if gold has already started to move, you may not have a new trend opportunity on a 4-hour, but you go down to a 10-minute, 30-minute, and you could come in out of the cloud and you get in that way. So we traverse across time frames for trend continuation trades and stuff like that more than anything. So I'm more towards using highs and lows for an indicator compared to an indicator based on closing price. So then kind of deviated from that. And it's all for one reason. It's the reward risk. To get the 3-to-1 reward risk ratio, I never could figure out how to make it work with moving averages. And that's kind of why I deviated away from it. So thoughts? What do you guys think?
No, it's great.
Different.
I love Ichimoku, so
Yeah.
I'm a fan of Ichimoku. So you're right. 100% agree with you.
Yeah, and that's kind of why. But
Mhm.
I'm you know, it's for me, the delayed part really inhibits on the money management side, and that's kind of where I move towards it there. And a lot of institutions are moving away from moving averages due to that too, especially volatility. You know, and Antonio, as you know, 10 years ago, we didn't have that much volatility, right?
Yeah.
Now, with volatility there, you're getting all these volatility spikes left and right. And you could just even see here, look at how it moved below the 10, came back above it, then didn't go make new highs, retested that here. Most people think it's a double top, but then it comes back here and then it bounces off there. So
Yeah.
you're getting caught in these swing motions here, you
Mhm.
know, the sideways patterns. And that's exactly what happened when the markets went sideways. The moving averages were killing me. And that's something I wanted to avoid completely.
Right. So yeah, I think I agree with that because I think a high and low, I think sometimes can give us a better representation, yeah, of where the market actually stretch. I mean, the closing prices indicators tells us where's the market finish, I think, but high and low, especially with this kind of volatility, I think tell us how far the market is actually gonna move, right? So you see, like that's double top trap right there. So I mean,
Yeah.
yeah, I truly agree with that.
And so that's the reason where I kind of deviated from you guys.
You know, I use
Any
the
comments and thoughts?
Yeah, I use moving averages more as an entry signal, but not as
Mhm.
an exit signal. I think it is,
Okay.
this is pretty
Mm,
interesting because I've noticed what you what you had. The moving averages will not give you a nice risk reward ratio if you follow, the all the trade with the
Yeah.
moving averages. So I use more support and resistance, horizontal support and resistance, and liquidity levels, for example, for my exit points, but not based on the moving averages. And I most of all use moving averages as an accessory or a confirmation of everything that I was seeing, because with all this change in the market, and you pointed very well, Manesh, that the market changes on in these last 20 years. The volatility became crazy. In the past we didn't have this. I was reading a book another day that the guy see that the old technical analysis book is not working anymore, right? And they're
No.
not working anymore to this increased volatility. So we have to adapt, and
Yeah.
and this is it.
Yeah, I think volatility is a new discussion for nowadays and also in the future. You know, how do these indicators adapt with volatility? Even like if you take Bollinger Bands, they're based on closing price. Now you're starting to see where they're now changed on high and low.
Yeah,
So Bollinger Bands, the new version of it, speaking of John Bollinger, it's modified for highs and lows to account for volatility. So you're starting to see a lot of like proprietary indicators start moving more towards closing price to highs and lows. And the same formula is similar, but now moving to highs and lows instead of closing price just to account for volatility.
yeah. The markets are getting crazy. I think that part of it is due to the electronic trading, right?
Yeah,
The electronic trading, and there's a lot of players on this electronic, and the electronic environment, it's connecting itself, and it's created like a monster of of a, of a trading vaults. And I think that this monster of trading vaults sometimes, or trades like crazies, and they see, they are not reacting, but I think that they overreacting a lot,
yeah.
that the manual traders did in the past. So I think this is part of the explanation, these crazy movements, and we have to adapt. Otherwise, we will be stopped out in a nice uptrend, right?
mhm.
No, definitely we have to adjust with time. Otherwise, the time will take us.
This is a nice thing that I always told to the people when they begin trading, because this is a profession that we will never stop studying. If you don't like
Yeah.
study, don't came to trading, because this is not your place, right? Trading, it's a constant observation, a constant adjustment. I think that every trader that has more than 10 years will trade completely different that they used to do in the past. So,
Well,
and the
that's the
market is
uniqueness
proving
with
itself.
ValTalk. Well, that's uniqueness with ValTalk, right? If you look at it, all of us trade differently, right?
Yeah,
There's a
Right.
reason for it and something. There's no right or wrong when it comes to trading at all. So everyone has their system. There's nothing wrong with it. Everyone thinks differently. They've gone through different experience and stuff like that. But there's no right or wrong when it comes to trading. It's just what fits your personality, what makes sense to you, and how you're going to move forward with it. As long as you're trading, that's all that matters.
yeah. No, that's the beauty of this profession.
Yeah.
Yes.
It
Right.
never doesn't get boring, does it?
Never.
The corporate world, I remember you go to meetings and emails and everything, it's kind of redundant tasks. This is where you wake up every morning, it's different. And that's the excitement behind it.
Yeah, it's a lion per day. It's, it's every
Yeah.
changing moment, especially with this volatility. You never know. So,
Yeah. Yep,
Yeah.
definitely.
I mean,
Well,
yeah, I
and
think,
sorry, Costa.
yeah, I think at the end of the day, yeah, as you said, yeah, we are unique with our own systems, right? I believe that a good trading system isn't like necessarily the most maybe the most hard, the complicated one. I think it's the one that each of us like understand and can execute consistently. I mean, back when maybe 3 weeks ago with Rion, that's about like a discipline or something like that. So the ones that yeah, we do
Yeah.
every day. We like every day.
Yeah, I think, yeah, everyone's different. So, well, any closing remarks? I know Ryan typically goes through closing remarks, but I'm gonna leave it you guys each to have your own closing remarks this time.
well,
Who's
from my
first?
side, I think
Okay, yeah.
uh, I can start. I can start. Basically, I think that moving averages is wrapping up. It's a very useful indicators. As you can see today, everyone has his own adjustments, but it works for everybody. And so I think everyone has to find his pitch on the market,
Mhm.
and his personal use with moving averages. So if you're not using moving averages, is this this chat today, he's gave you some good ideas where to start. And I think it's nice because it's the beginning of a mechanical trading system. A mechanical trading system are they're very good, that you can have a back testing your strategy with and you can see results, and you can gain confidence with the nice results. And just the beginning of a good in trading journal. It begins with a mechanical trading system, and moving averages can give you this. So keep an eye on it.
Yep. Okay. Costa?
Yeah, yeah. Again, I think the most important thing is to stay open-minded. Every trader has a different systems, a different perspective, different way of approaching the market, and that's actually what makes trading interesting, right? So I would say just so keep learning, like keep trading, and most importantly, enjoy the process of it.
I think you guys summed it up. I think it's the whole reason why Valtex created ValTalk is for different opinions to share with different traders, right? There's no right or wrong in anything out there. It's a matter of opinion. But I think, your journey as a trader is to find a system that fits your personality, that makes sense to you, right? And there's no right or wrong at all. Whatever works for you, keep on going for it, you know? So I think that's it. That sums it up. I'm kind of like always the antagonist, going against the trend. I'm not the follow the crowd person completely. So So if there's something to be done opposite, I think I'm there. You know. So, well, thank you for everyone that's joined with us. I hope you guys enjoyed ValeTalks today. It's a different viewpoint on moving average, one of the most popular indicators out there. As you could see, all three of us use it very differently, very different approaches and stuff like that out there. But I think that's it. A wrap up.
Yes.
Hopefully, we'll see Ryan back
great.
next week to host. I'm not a hoster, so.
No, but it did very well, Manesh. Thank you very much
Yes,
for
you
hosting
did
us.
Thanks,
very
guys.
well.
Let's get ready for U.S. market trading open now.
Yeah, let's prepare to the war.
Yes, definitely.
Mm.
Thanks, guys.
Thank
Okay,
you.
Enjoy your
thank
day.
you,
Thank
thank you,
you.
guys.
Thank you.
Bye bye.
Have a good day. Bye bye.